Yes, man. What is going on? What is going on? My name is Gerald Peters. Welcome back to the channel. Hey, man, I believe life is a trade, and that's what we have going on here now. I wanted to bring in a trade that we see going on right now. If you're on my trade of the week 2 weeks ago, this is one that we had that was running. Gang, what's up, Mike? Oh, what's up, man? What's up, man? How you doing? What's up, Nix? Hope you guys are doing well. Hit like on there. I want to talk to you. We're going to talk a little bit about Envx, see why this thing is popping. What's up, Major? This is why I got mad in Discord yesterday. I know. That's why I kind of got mad, man. I got people still fucking sleeping on it. We're supposed to be killing it. So we're on Instagram too. Hopefully, apparently, I'm trying to do both. They've just now started where you can live stream on Instagram while on YouTube, except it's sideways, which kind of jacks it up. But I guess it's better than not live streaming. Let me pull this up, man. And I want to play something for you here. If you got it last week, if you know, then you know. Gerald Peters here for the Peters Report. You're going to hear some banging. I got roofers at the house. I mean, a bigger move than this. Sound's not working, is it? Hold on, man. Sound's not working, is it? Sorry. I know, man. I apologize. I'm trying some new stuff. I got a new mic here. It's not working. I'll put this video down in the show notes, and or maybe we won't even save this. I don't know. All right, so let's get into Envx and the EVX. Let me pull up something here, and we'll look at this. And I want this is just a chance to do some time continuity, okay? Time continuity refers to the fact that the money flows fractal and it works across different time frames. If I keep looking off, I'm sorry, I'm day trading at the same time, man. And not the smartest thing to day trade while teaching a class, while trying to run the live stream stuff. I've kind of gotten used to it, though, I'm going to be honest. So just day trading is kind of boring now. All right, so I'm in this one. Now, this is a 1 minute, okay? TQQ. Now, come on, watch this. Boom. Now, you got a little gray area in here. If you have my course, getting started with stock charts. We talk about that. Those are the gray areas. But then sometimes the universe is just as nice as can be to us, and it gives us just absolute. These are tough too, these tails. We'll talk about that. The tails solved for me when you got that next bar right there. See, that tail's too far away. Look how far away that would be to use for any kind of trading. So I discount that. Those kangaroo tails, sometimes you'll get those at the top, like up here. It may run up real quick and then come right back down and close down here, okay? I would ignore that. I would completely ignore it. This becomes what I call a kangaroo tail. Now, yesterday, oh, come on, man. This thing was just giving us money. Now it's coming down. That is not cool. Yeah, so I discount these kangaroo tails. Remember, as above, so below. High tide, low tide. This is the bipolar nature, not only of yourself, the two selves. Geez, let's don't get into that. But the bipolar nature of the market. 1 minute it's going up, next minute it's going down. Doesn't seem to be any damn reason to it. Much like our emotions can be. The audiobook you were playing earlier, you were live in Discord, is fire. I downloaded it and started it from the beginning. Yeah. Went live in Discord, just did some silent trading, listening to the audiobook of the day. I listened to at least some bit of audio every day while I'm day trading. I actually was in that one. I had these headphones on. They work pretty good. Whatever I can hear, you guys can hear if I'm in Discord. I'm going to try to do that every day, man, if I can. I'll do it for, what did I go for? 30 minutes, an hour today trading? I only think I made a few bucks because I was only up a little bit from where I was. That I didn't lose any money, man. That's half the game of trading, is just trying not to lose money, okay? Hold on. This thing is running without us. Let me load this for a second. All right, so same thing you're seeing here on the TQ. Let's jump back to the trade of the week 2 weeks ago. Now, one thing this had going was fundamentals. Okay, this thing is what we call a seismic opportunity. It was nice to watch the trading. Now, you guys are going to notice, if you watch me trade, it will not be exactly as I teach you. Why? Because I'm trying to teach you some fundamentals, okay? I can't teach you intuitiveness. I can't teach you, I don't know if you can count bars as fast as I can. I keep a running count of the bars between stages. I'm being serious. Now, I can't do that if I'm teaching. I can't do that if I'm live. I can't do that if I'm talking. And you say, what do you mean? I keep a running count right there. If I can do this if I'm alone, it's like card counting, okay? I call it tape reading. This isn't some shit you can pick up running filters either. 1 bar, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So we have 21 bars in this leg. That's my count, 21. Oh, we're running now. So I'm going to trim a little bit on this. Wow. Check this out. Let's give this just a second. Yeah, it's unfortunate. I don't know why I'm having these sound problems. Something to do with the way I have my mic set, man.
Kryptonite and outline strategies to reduce the impact of negative trades. Building strength is important, but you must also minimize destructive and unprofitable behaviors. The most damaging of all forms of trade or kryptonite is biased or bad thinking, and we'll discuss bias in depth.
It's been coming down fast after hitting these,
focus on
by the way.
else that holds traders back other than irrational and biased thinking. When thinking about why traders lose money, the starting point is simple. Trading is not a zero-sum game. It is a negative-sum game. There are external costs like technology, hardware, research, data, personnel, etc., and transaction costs, commissions, bid offer, slippage, that eat away at your performance day after day. If you generate small gains, your alpha will leak away in a steady stream of payments to vendors and market makers. When I traded the NASDAQ bubble from 1999 to 2002, my gross daily P&L was rarely negative, and I was gross positive every single month. But I went from wildly profitable in 1999 and 2000 to flat in 2001 and net negative in 2002, as I had to trade more and more shares to generate the same P&L after the absolute value of NASDAQ stocks collapsed following.
Hold on, guys. That's a great ebook. I'll post that down in the video notes, and I think I posted it in Discord earlier, the Alpha Trader. We took down most of the trade right in here. Let's tell these people something. Live on YouTube. What's up, Brittany? So we'll post this. Give me just a second here, guys. All right. Now, so we're just looking at the 1 minute here of the TQQ. Now, you see it turning. Now, I missed my thing here because I was playing around. But you will notice when I'm teaching you trading, I won't have you get out on that. If I'm trading, I'm out right there. I trade bar by bar. And I also count the bars. I know, that's a lot, man. I don't expect other people to do it. I don't teach that. Maybe one day we can do an advanced one. What usually ends up happening is, oh, you didn't say this before. I know, because it's different. All right, hold on. Did someone put it in Discord? Please tell me you put it in Discord. Thank you, David. Appreciate you, man. All right. All right, so you're seeing this pattern play out here, right? This same fractal pattern that we play here. It says the money flows to trend following strategy that hopes to capture the uptrend and avoid the downtrend. Once we get below as a day trader, let me let you in on something. As a day trader, we are going through a lot of these movements fast. And so, you know, I can get in and right back out. It's a little harder on a daily chart. It's a little harder if you're not watching it nonstop. But that's the pattern, right? So let's get over here to Envx. And this is when we looked at picking it up. Now, we are already in this. And it had come way down. And down in here is when, you know, me and people that helped me research, we started looking. And I'm always looking for researchers. Sometimes I send out quizzes to see how people do intuitively. Ask them to give me their opinion on a stock. And some people do really well, and some people just really blow it. I mean, makes me wonder what they're doing. Or they just respond very quickly, or try to have a moment by moment conversation with me. I'm not trying to conversate with it. I just wanted to see what you thought about it. Without giving you my opinion. And with the people that help me research, I have two ladies that help me research. And that's the thing is I never give them my opinion or tell them what I think about a stock, whether I'm trying to be long, short, get out, take profit. You know, I never tell them anything. I just want them to give me the information and then their feeling. So if you were swing trading, this would be right where you would take your first. This is where you would take it, man. Boom. Right as this RSI is hitting 70 and you're hitting this box. This is a previous box and overhead resistance. Let's get back on the TQ for a second here.
The bubble burst. Instead of trying to make $3 on 1,000 shares as Qualcomm jumped from 600 to 603, I had to make 30 cents on 10,000 shares as Qualcomm moved from $60 to $60.30. The simultaneous collapse of stock prices and the decimalization of equity trading meant the highly profitable strategies I employed in 1999 and 2000 were no longer profitable by 2002. Transaction costs are a constant drag on performance, so you need a big edge to succeed in trading. Today, stock market trading is free in theory for many individuals, but you know the saying, if the product is free, then you are the product. In the past, you paid a transparent commission and the bid offer spread.
We're looking for this
now you still
70-12-ish range.
And you pay a hidden transaction fee, which is the profit earned by a high frequency market maker, which receives an ultra short term free option as it chooses how to execute your trade. Trading costs continue to trend lower, but are more and more difficult to observe or measure, and they matter. Another reason that trading is negative sum for individuals is information and technology asymmetry.
Boom, here we go.
Large institutions like banks, asset managers, and central banks have better access to information and superior, faster technology. A trader at home watching news headlines cannot compete with algorithmic headline reading software. When market moving news comes out, individual human traders are at a meaningful speed disadvantage. A portfolio manager at a hedge fund or a trader at a bank has a team of analysts.
We'll come back to it. A trader at a bank gets up just like you do to trade, except they're really trying to win. So that's kind of some of the people we're going against. We initiated the trade over here. If you look, where's it at? If you look, 9:24. Okay, that's when we sent the update. So let's pull up 9:24. 24. Boom. Come on, baby. So we're in. And then our entry zone holds here. That's an add point. Okay. A lot of people like to add when it's going down. That's because secretly you don't think you know what you're doing. You don't think you can react fast enough. I don't add when something's going down. I add when something stops and starts to go up. Stops and starts to go up, stops and stop and starts to go up. That's when we're looking to add, okay? If you're adding on the way down, you're either just dollar cost averaging, nothing wrong with that. The reason the money flow works is dollar cost averaging works. But why do that if you could do it better?
And quants working with them to extract signals from the noise. They have in-depth analysis of coming events and instant breakdowns of important news. The Twitter era has democratized this a fair bit and substantially decreased the advantage.
So time continuity. Yes, on a daily chart, we had our anchor point. We didn't have 4 bars, okay? We didn't have 4 bars. But what we did have was price. I keep forgetting I'd already over here, but when we sent the alert, it was on this side. We just sent the alert, the other day, last week on the 24th. So boom. So what we're trying to do is to buy exactly at the right fucking time. Exactly at the right time. Exactly. In a repeatable process that you could do over and over again. That's what we're trying to do. And the biggest mistake most traders make is actually buying at the wrong time. They tend to buy after it's already run. You got people right now talking about gold. These are complete dipshits. Anybody talking about buying gold now is a complete dipshit. If that's you, guys, we were buying gold when it was underneath the 200. GP, would you consider doing the class during the year at your place or Zoom? Yeah, we just did a swing trading class on Zoom. We had a good turnout, 134 people. Pretty good turnout. Uh-oh. Hold on. That's what I get for not watching. Well, let's see. All right, I'm still up on the trade, and I am out. That'll make it easier. Now, why am I out? Boom, because we dropped underneath the 5. It was actually, we went underneath the 5 and under the previous candle, and that's what I'm looking for. This was kind of a gap on us. Typically, you won't see those gaps. This down doesn't bother me. It turned right around and went up. It's when it drops below the previous candle, okay? And then if it turns right back up, cool. I get right back in. I'm day trading. And there's your pattern, right? This is the pattern. This is when I was sitting at the casino, man, and God started talking to me, and I saw it in my head, clear as day. Now it looks like the 5-minute just went flat. So if you're a short seller, boom, this might be when you get in the game. If that's the game you want to play. Now, it's kind of a dangerous game. And as a short seller, you need to see the 5-day exponential or the 5 period. Let me pull up another one here. If you're not on the trade of the week, I don't know. It feels at this point, it just feels dumb when we have stocks popping 20-something%. If you're not in it, it just feels like it's kind of dumb. Let's see. Day trade. Now, if they were popping the other way, I'd tell you to get out of it. We need the 5-minute. Hey, and if you're on there, guys, you can go back and look at the archive videos, okay? You can go back and just look. So if you're on Substack, if you just go to Substack, however you do it, you can go back, man. And so you can go to last one and the last one. You can go back through them, okay? And as you go back through them, you can watch those videos. All right. I'm getting back in over here. So I'm back in. And it's just running a little behind here, but you'll see why. And my stop will be right here. Right? So as I continue to play this trend, you could do this. Sorry for all the moving around. You could do this on a daily too. Hopefully it gives me a chance. This is my new jump off point, right? So right in there. Hopefully, come on, baby. There we go. You could do the same here on Envx if you wanted to. You could trade it just like I'm doing here, just like I'm day trading this.
Of the institutions over the individuals. There's a ton of high quality information and analysis on Twitter if you know where to look. Still, institutional information is generally higher quality and easier to access than the information available to those outside the industry. Let's look at some of the most common reasons traders lose money. 1, bad discipline. 2, not enough edge.
Adding shares.
3, over-reliance on simple indicators. 4, too much focus on trade ideas and not enough focus on risk management. And 5,
69.96.
Let's start with bad discipline. The number one reason that traders lose money is bad discipline. No amount of edge or skill matters if you cannot stick to the plan. The most amazing alpha-generating strategy is useless if you deviate from it. The most sophisticated, optimized, and adaptive risk management system will fail if you selectively ignore some of its rules and procedures, depending on your mood or emotional state. Every time you deviate from your process or plan because of that or emotion, you lose money. Learning the rules is easy.
Why would I add right here?
Hard. I am highly qualified
because
to talk
I'm
about
adding
discipline in trading.
Stop.
Because my best
so
and worst
if it would have
always
rolled over, I'd have been out instantly.
The market is like a siren from Homer's
So that'd have been a second,
crash your boat into the rocks,
just seconds long trade.
Trying to make you break your own rules. Overtrading is my kryptonite, and I could write an entire book about my own battles with bad discipline. One of the great contradictions of trading is that conservative, disciplined people tend to be risk averse.
Now look what happens.
People tend to be compulsive. And
I added at support on purpose.
Just a general relationship between
because I knew I was either getting out or staying in.
The paradox of trading is that it demands you be both risk loving and highly.
Now look what happens.
Most people.
So we added it.
69. This is the essence of the tight aggressive philosophy described earlier. You follow the rules, you wait, you analyze.
So now the trade's up much more than it was.
Ideas, and then finally, a juicy trade
and I'm gonna start downsizing it now.
Aggressively. Bad discipline often reveals itself as overtrading, gambling, or trading for fun and stimulation. Another symptom of bad discipline is the inability to stick to the plan, moving your stop loss and take profit when they get close, for example. Often, this is a simple emotional reaction to movements in price. When people own an asset that is going up, they have trouble selling it, even if their initial plan was to take profit at a particular level that has just been reached.
Not me, I'm selling.
Is an issue for you. Spend most of your time
getting into the box where I told you it would go.
Automate your process as much as possible. Bad discipline is the number one source of trader kryptonite. There is a demon voice in many people's heads, the voice that tells skinny women they are fat or convinces alcoholics to have just one drink. That voice is there to sabotage you and your trading. It can make you do
down to half my shares,
and often you will barely understand your own actions when you follow it. Have you ever heard a voice in your head saying, just hold on a bit longer, it'll bounce back, get back to flat, then square up. No point taking the loss here, it'll definitely bounce. Or the stock's rallying. You can't miss this move. I know you stopped out at the low already, but you have to buy the high now. You're going to miss a huge rally. The guy next to you is long at good levels. He's making so much more money than you. Do you control that voice? Or does it control you? This sort of stuff gets existential pretty fast, and the voice in your head is the subject of many books and articles on psychology, mental health, self-help, and philosophy. The duality or multiplicity of the human mind is an incredible and fascinating topic, and you should be aware of how and when these voices in your head sabotage you. Understanding how your ego and non-productive voices in your head manipulate your behavior and self-worth is a critical step towards self-awareness. You must recognize when the wrong voices tell you to press the buy and sell buttons. Meditation and mindfulness training.
Now you're going to say, but the RSI didn't hit. You told me to sell on the RSI.
And control the non-productive, negative,
or disruptive voices
in your head. A well-designed process and an
I know where it was going to go.
Also help, as they create fewer decision points where you have to intervene or actively make decisions under stress. The less you have to decide on the fly while in a position, and the more your parameters are laid out beforehand and not subject to revision, the better. We will get more into risk management in Chapter 11. While bad discipline often kills off otherwise good traders, bad traders usually lose money because they suffer from one or more of the following problems. Not enough edge. Whether you trade at the biggest asset management firm in Midtown Manhattan or out of a spare room in your parents' house in Wichita, Kansas, trading is an impossibly complex game of imperfect information played by many thousands of technologically sophisticated
and highly motivated
opponents. What is your edge?
You might be ready to add right here at support.
Explain their edge. Do you have enough edge to outperform the market and exceed transaction costs? This is the most important question in trading.
What's your edge?
Especially if you do not work at a bank. Banks have some built-in edge, like better information, market-making revenue, and the best access to liquidity. But if you work at home or at a hedge fund or at an asset management firm,
taking a small position.
Don't lie to yourself.
Think on the support level here.
Sources of edge. Let's take a detour for a minute and look at some sources of edge over the years. There are many other sources of edge, especially at the micro level. This list is meant to get you thinking about your own edge. The point is not to go through the list and pick one. It's a starting point for thinking about and understanding your personal
I'm going to blow out of this if it breaks.
There's a cliche that if you're at a poker table and you don't know who the sucker is, you are the sucker. Similarly, if you are a trader and you do not know what your edge is, you probably don't have an edge.
69.97.
I will focus on sources of edge for human traders, and the date ranges I provide are my best estimate of when that source of edge was most prevalent. Most of these sources of edge still exist, but are greatly diminished from peak. Trend following, 1984 to 2003. Trend following systems were the go-to source for human and computer alpha in the 1980s and 1990s. Many large trend following commodity trading advisors, or CTAs, extracted meaningful abnormal returns for more than 2 decades. Returns from trend following systems have steadily declined over the past 40 years. Many studies covered the slow decline of trend following performance.
Adding shares.
A study by Winton showed the steady decline in trend following Sharpe ratios over time. From 1984 to 1993, the Sharpe of trend following strategies across 20 asset classes.
The money flows, a trend following strategy. Back to Envx. Envx is up. It was 22% earlier. About to blow out here. Yeah, I'm gonna get out while we're on here. We'll see if this thing breaks down. I'm gonna set up for a possible short position. Anyway, boom, big thing. Personally, I'm not trimming any here, man. I think we got, my anticipation on this is hundreds of percent. I expect this thing to go hundreds of percent. Okay. I'm not looking for 20%. You may not be used to winning much, so maybe 20% feels like a lot to you. I don't know. It's not a lot. We want to get it up here into the 18, but I'm talking about $30. So that's a long ways from here. So it's 3x from here. But if you see that money flow pattern there, what is this? Here's the green line, okay? The green line. Until price is on the other side, it can't be stage 2. So all of this is either stage 1 or stage 4, right? Hold on. Sorry. I'm in a short position, but it seems to be moving against me here. Anyway. So as long as price is on this side of the green line, all the way down, that's either a stage 1 or a 4. It can't be anything else. And on this side of the line, it's either a 2 or a 3, right? Oh, I got to get out of this. Gosh darn it. Let's get back over here. This is getting it's getting kind of tricky here, man. I shouldn't even be in, I don't think. Let's check the 5-minute here. Looks like to the downside to me, but it is trying to come back. I'm going to jump in on the long side. So tried the short side, took a little hit. Now we're going to try the upside. Now, keep a count from here. So we got 3 bars. You know, I mean, we have from here to here. So we've been running, what, 26? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. All right. Now, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. So we're ripping to the upside. So that number 26 seems to keep coming up for stage 2s if you haven't noticed. Now those are bar counts, trading bar by bar. Now we could do the same over here on a daily. Big breakout. And then how many bars? Big breakout. This thing could just be getting going. This was a massive breakout right here. And so that's what I want to show you on the chart. This is a big breakout right here. From here to here is about the same thing, maybe a little more than 20%. And then it goes from $6 to 18. We could easily go back to 18. So if you're in Envx with me, trade of the week, shit, I begged a lot of people to get on the trade of the week last week. You'd be up big time. All right. I might be trimming some here. That's all I really had on Envx, but let's let this trade run through. I'm trying to, I was live day trading on my actual trading platform today. Where are we at? All right. We're making a run for the box again, guys. Oh, we're in it now. We are in it now.
Was 1.85. From 1994 to 2003.
I would hold Envx. I wouldn't sell it.
In 2004 to 2013, it was straight up
I'm
0.
expecting a lot more out of
This
it.
does not show there are 0 profitable trend following strategies, but clearly the edge has dropped over time. This is not a surprise given the proliferation of academic literature on the topic in the 1990s and 2000s.
All right, we just broke out of the Bollinger Bands,
becomes well known,
which means we're back in the box, which means the RSI should be going extreme here.
And lack of transparency.
We're at 70-12.
Before the internet, markets were opaque, and it was hard for those
I'm gonna
outside
put
financial institutions to get an accurate view of prices.
Limit order in it.
Traders at banks and large investment firms had a meaningful advantage given their knowledge of accurate price levels and because of wide bid-offer spreads. Meanwhile, relatively few macro traders had big research budgets or access to policymakers. Those who did had a massive edge over less informed and less sophisticated corporations and speculators. Instantaneous communication speeds, near unlimited availability of information, and rigorous compliance and
limit orders just hit.
Information have dramatically flattened the landscape for both macro and bank traders at this point.
Putting another one in at
7.25. The most common trading strategy on most
70-25
before 2006 was technical analysis. Most techniques were fairly basic, while some of the smarter sounding people might throw in some Elliott wave or more esoteric systems built in Lotus 123. Most of these strategies produced what amounted to trend following or breakout signals. Continuation patterns, breakouts, head and shoulders, etc., were the favored setups, and these piggybacked on the underlying high sharp of trend following strategies in that era. As algorithmic strategies became more common in the mid-2000s and trend following sharps fizzled, traders using simple technical analysis lost their edge because technical strategies are easy to replicate with a computer, and computers are better than humans when it comes to risk management and unbiased trade selection. Now, I believe technical analysis has been reduced to a risk management tool and does not work effectively for trade selection or forecasting. Analyzing price action, 1970s to 2015 or so. It feels to me that price action in recent years has become increasingly meaningless.
I wasn't ready with my
The idea that something trades well or looks big pretty much just means it's at the highs these days, not that it's going higher. Price action has lost most of its forecasting value. I think very short term, there is still meaning in good news, bad price setups. That is, when something can't rally on good news, that's temporarily bearish, but this effect has a short half-life. Here's Stan Druckenmiller commenting on the decline of price action.
One of the best traders ever.
In 2018. Quote, "These algos have taken all the rhythm out of the market and have become extremely confusing to me. And when you take away price action versus news from someone who's used price action as their major disciplinary tool for 35 years, it's tough, and it's become very tough. I don't know where this is all going. If it continues, I'm not going to return to 30% a year anytime soon. Not that I think I might anyway, but one can always dream when the free money ends, we'll go back to a normal macro trading environment." End quote. I think perhaps algorithms, which are less emotional and react less predictably to news, are partly to blame for the decline in the importance of price action. But there could also be the simple fact that everyone knows about this style of analysis, so it has lost its edge. The current generation of 30 to 45-year-old traders were all brought up on reminiscences of a stock operator and market wizards, and thus we are always scouring the price action for a signal. Throw in the massive price distortions from non-price sensitive central bank buying of various assets, and it's not hard to see how whatever signal price action might have carried in the past has been destroyed by central banks and arbitraged away by speculators who all learn from the same books and interviews. Global macro, 1970s to now. Global macro is very crowded as the proliferation of pod-based hedge funds and internet macro strategists pushed global macro into the mainstream around 2005 and left too much capital chasing too little alpha. If you assume that any market strategy or inefficiency has X amount of alpha available, then the more actors trying to gobble up that alpha, the lower average returns and average sharps must fall over time. Too much competition and low interest rates are the top two challenges to global macro hedge fund returns since 2008. Massive moves in asset prices driven by Fed QE, Abenomics, and ECB QE delivered monster alpha to hedge funds at various points in the 2010s, but these epic events have been rare in recent years. Macro had a big comeback from 2020 to 2022 because of COVID and the related market disruptions. Correlation and intermarket analysis, 2004 to 2014. This was my bread and butter back in the Lehman Brothers days, but after the 2008 global financial crisis, everyone became acutely aware of the importance of correlation and intermarket analysis for short-term trading. Just about every global macro trader and blogger in the world is highly proficient in this style of analysis now, and there are many, many computerized systems using dynamic correlation to trade every asset class.
I'm gonna add shares
too much
here.
Money chasing too little alpha. I still use correlation as an important input for my trade ideas, but I think its usefulness has declined significantly over the past 20 years.
Never mind.
Trading the data,
Didn't get it off fast
2005. It's 1997.
Out.
I expect a strong non-farm payrolls number, and dollar yen is 118.8085. As 8:30 a.m. approaches, I key up a bid for $100 million yen at 119.01.
Oh,
I
shit.
stare intensely at the U.S. economic release page on Bloomberg. 5, 4, 3, 2, 1. If the number is significantly better than expectations, I hit send. If not, I do nothing. Often, before 2005 or so, you can scoop up all the lazy offers left by risk-averse traders and make an instant $100,000 or $200,000 profit in the seconds after any major economic release. Now, there are hundreds of algos set up with a series of commands like, if non-farm payrolls beats by 1 standard deviation and unemployment rate drops by $100 yen, limit X. All available liquidity is sucked up.
You're not going to believe what I just did.
As an army of algos wipes the battlefield clean. There are some second derivative ways.
So I forgot I had the limit order in. So I'm trying to bail out of the trade. And I can't. Now this time that worked to my favor because it's actually come back a little bit from where it was. But that is a rookie mistake, man. I still do it often enough. I shouldn't do it, but now I'm just going to sit here a second because it's actually come back. So that little mistake saved me. So I may add to it. We'll listen to this out and then I'll cancel. But yeah, I put the chart down there for Envx. So if you go check out That was 2 weeks ago. This is some of the videos we sent in the trade of the week. Okay. So again, out where we at here? 5 minutes showing down, huh? Yeah, we'll give this just a second. I'm adding to the trade. I was trying to get stopped out, but I'd be getting it in anyway right here. So my mistake worked to my favor today. I'm really enjoying this book. This guy's a professional. I mean, anybody takes a trade is a professional trader. Just some people aren't good at it. This guy here works for
to make money trading the economic data now, but 95% of the alpha is owned by the algorithms. This creates a form of singularity where price finds its new
I'm in a full
equilibrium
position
almost
now.
Instantly after economic data hits the market. Instead of flailing all over the place as it tries to find the right price, Delium just ratchets to the new correct price in a few minutes as similarly tuned programs react at faster than human speed.
Come on,
Pattern
baby.
recognition, 1980 to now. There's
Freak
a famous story
off!
of Paul Tudor Jones and Peter Borscht using price
Getting
and
a
volume
freak off
patterns to
here.
uncover an analogy between the price and volume pattern in the stock market in 1987 and price and volume in the stock market in 1929. Using this analogy, macro analysis, and his concerns about derivatives, portfolio insurance, and equity futures without price limits, Tudor predicted the crash of 87 and returned 62% in October 1987. In the present day, this type of analogy would be tweeted 22 times by day traders and online bloggers and would be revealed in the output of every machine learning, AI, and pattern recognition machine at every hedge fund and bank in the world. Computers are significantly better than humans when it comes to unbiased pattern recognition. I do believe, though, there's still an edge in pattern recognition. Experienced human traders can still combine complex pieces of information to form conclusions that would elude the best computers. Leverage, carry, and selling risk premium forever. Borrow at 2% and buy an asset that yields 7%. Carry and roll down. Sell insurance to hedgers. Sell SPX puts. These are the tried, tested, and true ways to generate consistent returns. These strategies produce non-normal returns and lead to occasional blowups and meltdowns, and are often more beta than alpha. Tactics like timing on entries and exits and superior risk management, though, can make simple levered carry and option selling strategies more like alpha and beta. Quant discretionary combo, 2012 to now. While quantitative analysis was once mostly the domain of systematic and algorithmic trading programs, human traders now use more sophisticated quantitative methods. Combining the best quantitative analysts, the best data sets, and the best discretionary traders into one business pod looks to me like the ideal model for discretionary alpha capture in the current era. Quantitative analysis is greatly enhanced by experienced humans who can ask the right questions. Models are great for many types of trading, but are not as good at other tasks such as predicting or reacting to regime change or handling one-off events. All these styles of trading still work off and on. The challenge is to find a trading style that gives you an edge in the current market, and then stay clear-eyed, open-minded, and adaptable so you can transition or pivot as the market changes. Your edge this month might not be your edge next month or next year. Detour complete. I hope this brief roundup of historical sources of edge helps you think about and identify your current edge. This brings us to the next reason that traders
16 count.
Over-reliance on simple indicators. Many traders put way too much faith in simple indicators. While there's something to be said for simplicity, you also
16 count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Come on, man. Really? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. This is 16 count right here. Gosh darn it. Gosh darn it. Golly willikers. 16 count right at the 200-day moving average. So I'm going to add shares and then be ready to bust out right here. This should hold. If it doesn't, I bet it breaks, comes right back in the box. If it breaks, watch for it to come right back in the box. It's a 16. Gosh darn it. I'm out. that surprises me. Although the 5 has said we're going down, I really thought that was going to hold. It's going to come back, dude. This, watch. These motherfuckers.
So need to be realistic enough to grasp that drawing a trend line on a daily chart and buying the break of that line is probably not a strategy that will offer much edge in the long run. Anything a computer can easily do is unlikely to be a huge winner. Many retail traders get sucked into seminars and trading courses that advertise simple breakout or similar technical strategies. Often the sellers of these strategies offer up impressive data showing that a particular strategy has generated outsized returns. Remember that this is all backward looking. Using any simple trading software, I can backtest a few thousand strategies and then cherry pick the ones that were incredibly profitable in hindsight, then advertise those. The problem with this sort of analysis is that it does not work out of sample. In sample is data you analyze to come up with a strategy. Out of sample data is a separate set of data you use to test the strategy.
You get ready to go
This
short.
helps avoid data mining and snooping problems because almost any set of data will eventually yield what looks like a decent strategy if you torture it long enough. Do not believe the hype of online trading seminars that claim consistent profits from simple technical indicators. There is an entire industry built around the idea of easy profits and simple strategies, and the sad fact is that these programs do not work. Instead of dumping $15,000 into a bogus training program, put $10,000 into a trading account and buy a huge pile of trading books and a bunch of meditation classes. Think of that $10,000 in a trading account as tuition and start trading very cautiously. Reliance on simple indicators is not just a problem in retail trading.
I'm going to try to catch this
bounce. A bank trader will send out a trade rec featuring something like a trend line going back 5 years that just broke. They will advocate a trade based on the breakout. Personally, my philosophy is that simple is going right back to the box. But there's a point where analysis is too simple. Buying an asset because a line on a chart broke belongs in the too simple category for me. Does it really pass the sniff test that you can draw a line on a chart, then wait for it to break, and that will be a sustainable source of alpha or edge in a complex game played by the most expensive computers and some of the smartest human beings in the world? I doubt it.
Now watch this. This thing came right into the box and literally turned around. You see that? Tell you that zone right there, man. That zone, that's the magic zone. That's the 16 count zone right there. I don't know, man. I'm going to take a shot at the short side here, but I don't know, mate. Oh, I'm actually going to go home short, actually. So I'm going to add to this now. It's 3 o'clock. I've been going home short just to as a hedge against the margin that we carry in there. Let's check the daily chart. And then before I confirm, I'm actually going to do that. I was up a little over $300 today. We'll see if I kept it here. I don't know if I dumped some. QQQ. Shit now. We have an inside candle day, huh? Let's count it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Okay. Let me see if we got anything going here. I'm using that there, okay? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All right, so we got 10 down count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, it did there. And it tried to go stage 1. Jesus. Interesting. You're seeing a lot of 10s in the individual stages, and then you're getting a 10-bar run up, pull back, 10-bar run up, pull back. Basically 10 bars you count here, pull back. Didn't really get a run up, so we didn't get that going. Then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10-bar pullback. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Pretty damn close. You got the outlier. Interesting. I'm always counting bars, man. I don't really talk about what I do with the bars I count, but you can go into the after hours. The market's still going right now. Just make sure if you trade, guys, if you trade in Envx, hold it. I wouldn't trim it. If you trade in the after hours, you got to use limit orders. Got to use limit orders, and you got to set it to extended after hours. In E-Trade, you got to turn that shit on, okay? You guys be good. Talk to you later. Appreciate you. Hit the QR code, man.